quick recap of what we've learned. I actually looked this up just a moment ago. We held, as far as I can tell, our first study group that was devoted to this topic back in 2006, so coming up on 5 years ago. This is either our 9th or our 10th session, either in person or virtual, again, that has focused on financial planning. We've learned a lot, both through those dialogues and also the several years worth of research and study that we've put to this. I mentioned the first study group we conducted on this was back in 2006. That same year, we published a study that looked at financial planning from the standpoint of the consumer. We used a nationally representative a survey of consumer financial behavior to explore what happens when a financial institution delivers a plan to a client. And what we found is that it's a win-win-win for everyone involved. Households with a financial plan are twice as likely to have a great deal of confidence in their financial future. So having a plan from the client's perspective seems to make them more confident. So it's good from the client's perspective. In almost all cases, the advisor that delivers the financial plan becomes the household's primary trusted financial advisor. This is a powerful position to be in because being the household's primary advisor correlates with greater loyalty as well as depth. And right to that point, households with a financial plan from a bank or credit union keep 85% more of their savings and investments at that institution. So it's a win from the standpoint of the host institution as well, because the delivery of the plan seems to correlate with the household moving the household's assets into one place, into your bank or credit union. That same study, even though it made a strong argument for the power of financial planning, again, from the standpoint of the client, that study actually fell short when we tried to answer the question, does doing more planning result in higher productivity for the advisor? The data that we looked at seemed to suggest the opposite. Firms that do more planning have slightly lower productivity, average productivity, than firms that do less planning. That didn't sit well with us. It didn't make sense. It also didn't square with some of the other data that we kept hearing about from our sponsors and our clients and others. So we had to take kind of a novel approach, which was moving from firm level data, comparing firms that do more planning against firms that do less planning, and moving to advisor level data. We assembled a robust database of, again, advisor level data. So this is data that covers everything that you'd want to know about an advisor that could impact their production, their tenure, their book size, their territory, their business mix, so forth and so on. And of course, how much planning they do. Once we had that data, the picture became clear. More planning results in higher productivity. Now that confirmed, I think what a lot of us thought. There's an interesting thing to note there, which is that the impact to production accelerates as the advisor does more planning. So that is to say, the line that describes this phenomenon is shaped a little bit like a hockey stick. As an advisor moves from doing very little planning to doing a little bit of planning, the lift to their production is minimal. But as they move from doing a little bit of planning to a lot of planning, the lift to production becomes very, very large. So that's an important nuance to understand as you're coaching an advisor up the planning ladder. One question that's come up time and again in our in-person and virtual dialogues is, who should have a financial plan? Which of your advisor's clients should have a plan? We found the answer to that question varies widely, but there's a growing consensus that most clients should have a planning light or a foundation plan. And we've seen as the financial planning tech companies have moved in the direction of offering more solutions to that end that allow firms to deliver a form of a financial plan to a broader swath of their clients. And then, of course, for your advisor's core clients, there's still great value in delivering an in-depth plan. Finally, we've dug a little bit into how firms go about delivering planning to their clients. And one thing that has stood out is that in most cases, advisors and banks and credit unions are preparing and delivering the plan on their own. But in those cases where the institution is providing support for the planning process through the use of planning coordinators or dedicated planners, those firms achieve a much deeper level of plan penetration. So, these facts together, right, would seem to make a pretty strong argument for why our firms and our advisors should be focused on this issue. It's a win-win-win. Advisors that do more planning will enjoy higher production. And we're beginning to sort of piece together the keys to what it takes to do more planning.